Multinational companies structure themselves to avoid paying taxes, corporate taxes, and then so what that means for how we measure things, in particular how we measure the domestic economy, the U.S. economy. So a lot of people are worried about what corporations do for their profits in regards to tax revenues, what the government can collect. Here one approaches from the side of, as an economist who's interested in the real side of things, how does measurement affected by what these firms are doing? And so I'm going to show you guys results from two sets of papers that are joint with Fatih Gouvenin, who's at the University of Minnesota, Ray Maddaloni and Dylan Rossier, who are at the BEA, the Bureau of Economic Analysis, and also Jennifer Bruner, who's also at the Bureau of Economic Analysis. So let me start just by talking a bit about what I mean when I say profit shifting. So I'm thinking about multinational corporations. In the United States, multinational corporations account for about 40% of U.S. employment. So these are all the big firms that you know. If you know the name of a firm, it's probably a multinational. And so what's interesting about multinationals is they have access to production in lots of different countries that differ by their tax rates, right? So the United States has a high corporate tax rate. Bermuda has a very low corporate tax rate. It's 0. Right? And so this creates incentives for firms to structure themselves to at least make it look like they're earning profits in places where the tax rate is low, whether or not they're actually doing any production there. So we call this profit shifting. So the firm sort of structures itself to be able to do this. And one of the ways it does this is through the location of intangible capital. And that's going to be sort of what we're talk a lot about today. Right? And so the idea is, suppose I have a patent. So I'm Apple. I hold the patent for iOS, which is what most of the value added of an iPhone is. It's the software in the phone itself. The hardware is actually not worth that much. Right? I can build that phone in China regardless of where I hold the patent for iOS. So I want to hold that patent somewhere where the corporate tax rate is very low, and then every time I sell an iPhone, I want to pay my royalties not to the United States, which is where that software was invented, where that investment was made, but somewhere where the tax rate is low. Right? And so this is very much what firms do. They want to put their intellectual property in places where there are low tax rates and then let their profits accrue there. And the problem from a measurement sort of standpoint is that now we're sort of seeing reported profits from places that don't necessarily reflect economic activity. So how did I come to working on this paper? I still work on, actually what do multinationals do? Where do they produce? Where do they trade goods? And the first thing when you start looking at data, people tell you is, well, you want to throw out Bermuda, Switzerland, even Ireland. And he said, why? Why do I want to throw those countries out? Oh, because their data don't make any sense. It looks like they do lots of stuff in these countries. They don't actually do anything there. And so I thought, well, that seems, if this is where everything looks like it's happening, maybe we should go back and try to understand what's happening. So this is what I'm interested in today is how do we come back to sort of what the actual real things our multinationals are doing once we kind of control for this. So let me just give you a quick example of how this works. So this is this very famous arrangement of firms called the double Irish with the Dutch sandwich. And you'll see for a reason why they call this. So suppose you're Google. This is actually something Google does. So Google is located in the United States. That's where they do most of their intellectual property investment. And then suppose you want to sell ads. That's what Google does. They sell ads to Europe, the Middle East, and Africa. Right? So there's their foreign operations. So you open up an operating company in Ireland, and that's where you sell all of this. Where you do all your work from. So you hire a lot of people, you sell ads throughout Europe, and you collect revenues here. Now, but if you're Google, this isn't how you structure your company. You instead open 3 extra firms in the middle. Right? And these firms don't do anything. These are all holding companies. They're on paper, but they don't do things. The first thing you do is you open a company in Bermuda. That's where you want all your profit to end up. That's where the corporate tax rate is 0. And then you open up a firm in Ireland. That's a holding company, not the one that's doing the work, but a holding company. And you open a second holding company in the Netherlands. And so then every time you get $1 of revenue from here, you take your patent on however AdWords, whatever Google's intellectual property is, you license it to your holding company that's a tax resident of Bermuda, who sublicenses it to the Netherlands holding company, who sublicenses it to the Irish company that's actually doing the work. So then $1 comes in from selling some ads, and that's all the return, not to the people working in Ireland, it's returns to your intellectual property. And so then you go right back up the chain by paying royalties through this set of holding companies, and then not back to the United States where the intellectual property was created.
You have a line going from Ireland, top Ireland to
this, yeah.
But that's really not there.
This is tiny. No, you pay something. So you say, yeah, for every $1 of, so I do owe some royalty, but this is sort of the transfer pricing issue. So, and that's the point. So when you have some patent and you license it to your company in Bermuda, what's that patent worth? I don't know. Maybe it's not worth very much at all, right? Or maybe it's the patent for iOS 10. What's the difference between iOS 9 and 10? Not that much. So maybe I'll just pay you the difference between 9 and 10 and I get 10. Right? So this is where the transfer pricing issue comes. So I pay a little bit of royalty back to my company, but these in the data are very small. And most of the income accumulates here. So both the asset, the intangible asset, and the profits accumulate in Bermuda, not in California where the actual work was done. Right? And so that's going to be the measurement issue. We're putting all this money into building software and other intellectual property in the United States, but the return to that investment is not being captured in US GDP. And so it looks like we get a really bad return on our investment. It looks like we're not very productive, so on and so forth. So that's what we're trying to measure, right? So to give you a sense of how big this, yes. I'm sorry, say, this particular, so by sticking, yes, so the Dutch sandwich part is a idiosyncratic part of the Dutch law, tax law, is that you avoid what would be a tax being paid if this Irish company paid this Irish company, they'd have to pay an Irish tax. By first funneling it through a Netherlands company and then back to an Irish company, you miss a tax. Yeah, so this is all very idiosyncratic, right? Why the Netherlands? Because that's what the law says. Why Ireland? Because that's what they have the right kind of laws. And so this is one particular sort of arrangement that Google, Starbucks, Facebook, and Apple all use. So that's why I'm showing you this one. This is one you might have read about in the New York Times at some point. But there are other versions of this too. But the main idea is just sort of end up with this kind of stateless company that pays neither tax where they're actually doing stuff or tax where they've collected their profits. So it's a very advantageous sort of way for these guys to structure themselves. Yes, sir. Yeah, profit tax, not sales tax, profit tax.
And then once it's in Bermuda, where it goes to shareholders?
So, okay, yeah, good. So this is the last part about the U.S. tax code, and this is what's recently been changed if you've been following in the U.S. So up until 3 months ago, once those dollars accrue to Bermuda, you can do anything you want with them besides bring them back to the United States. So you can build an Apple store in London. You can build an iPhone manufacturing plant in China. You can do anything you want besides bringing them back to the U.S. Once you bring them back to the United States, then you incur the U.S. corporate tax rate. So we call this the repatriation tax. And so we heard all these stories about how Apple has $600 billion of cash floating around outside the U.S. And the whole point is,
Lots of it's in Bermuda.
And lots of it's in Bermuda and places like that. And the point is to avoid paying U.S. corporate tax. Now, the new tax law says two things. One, we're no longer going to tax your foreign profits. So we don't care whether or not you're going to bring the cash back or not. We're not going to tax it. And we're going to go back and tax all of your old profits one time. And so that's to exactly try to get around, to avoid these sorts of your foreign profits. So we're going back. So your Apple, you earned $1 trillion over the last 20 years outside the U.S. that you've never brought back. We're going to tax that one time. That's your penalty. You would have had to pay 30%. Now you're going to pay 8% or something like that on it. But that's what the new tax law says. So we're going to just, and then to wipe the slate clean, you pay tax on all your old profit, and now we don't take any piece of your foreign profit anymore. Which is what the U.S. has this weird system where they tax your worldwide profits. Spain does not tax the worldwide profits of its companies.
So going forward,
you
make profits in the U.S.,
you pay U.S. tax.
but if you make profits abroad,
You don't pay U.S. tax. That's right. No, you pay the foreign tax. You pay whatever the corporate tax rate should be in that. So going forward, you sell stuff in Ireland, you owe Irish corporate tax, which you owed anyway, even under the old system. But you don't pay Irish tax by diverting everything into Bermuda. So this is still going to happen after the new tax law.
you don't avoid American tax. What did you say? You don't avoid American tax.
There is no American tax anymore.
I know. So before you're
So now it can go all the way back to the U.S. parent to compare it in
That's right.
dividends.
Yeah. So it could now it would go into Bermuda, and then after it goes to Bermuda and you've paid no corporate foreign tax on it, it could go back into the United States.
Yes, Kim. This is fascinating. This is, you're giving us an economic history course. This is old-time news. This is up to 3 months ago. Everything you're going to tell us now is irrelevant.
No. You still want to earn your profits in Bermuda.
Why?
Because you don't want to pay Irish tax.
Oh, Oh, so that's a way to avoid paying Irish tax.
The only thing that's different, the only thing that's different from 3 months ago to today is, do you leave your money in Bermuda or do you bring it back to the U.S.?
Oh,
Now firms can bring it back to the U.S. if they want. You still want to do this.
Still set up the thing
Yeah.
in the middle. To
Yeah.
avoid
You still don't want to pay Irish tax. Okay, so here's just a quick sense of how big these what this means, right? So what is this? So this is take all the, I'm going to focus on U.S. data because that's where we have good data for. So take all the U.S. multinationals and their foreign affiliates in the rest of the world, add up all of their assets. So they're just, think about their balance sheet, cash, physical assets, anything, all their assets. And then let's look at the ratio compared to productive assets. So here's physical capital. So this is the ratio of all assets to the value of physical capital in U.S. foreign affiliates. So in Canada, that's like about 6 times the size of the balance sheet. Assets of the balance sheet relative to physical capital is about 6 in a place like Canada. When you look at tax havens in Europe, it's 20 times in Ireland. It's 1,000 times in Luxembourg. There's 1,000 times larger assets relative to productive assets. You can do the same thing with workers, either in compensation or employees. Right? In the Caribbean, these low tax rate companies. So this is.
Who's getting paid in Luxembourg?
This is, for example, Amazon has a affiliate in Luxembourg. They sell stuff in the EU. They pay all their profits into Luxembourg, where the tax rate is 0. So Luxembourg is.
There's 5 people in some office,
And they're making 10 billion each?
and they're making billions a year.
Yeah, this is millions per person. Yeah.
I don't get it. Are they actually making the money?
What do you mean by making?
The firm makes profit.
Yeah.
There's one guy who sits in Luxembourg, and he's got a big stack of patents next to him.
Yeah.
And he gets all this money from the patents, it's just funneling into his company.
Personally, that's his
No, it's not his income. No, that's Amazon's
Your
income.
compensation.
Oh,
No,
that
this is relative.
her compensation.
So look, this is the ratio of the asset side of the balance sheet, right? Total assets divided by either physical capital, compensation, or number of employees. Yeah. So,
But those 5 guys in Luxembourg are making profit from the affiliate in Spain, France, whatever.
Yeah.
But they're making 121 million euros a person.
Not
Their
the.
salary is only 100,000.
No. The making is the confusion.
No.
part.
Corporate.
You divide
The
this
corporate
by
profit is. This is all corporate profit. Yeah.
Very high exploitation of labor.
Yeah. No, and this firm in Ireland is doing all the work. Their profit is almost 0. They have huge revenues, but they have huge expenses. What's their huge expense? Royalty payments, right? So this firm is making a lot of profit, and there's like 2 guys there. Maybe they don't even live in Bermuda. They live in California, right? This firm hires thousands of people selling ads all over Europe. They have huge revenues, huge expenditures, no profit. It all goes back to there, right? And so this is just to give you a sense of how big these numbers are. So they're huge. Bermuda, Barbados, includes the Cayman Islands and things, right? This is $200 million of assets per person, compared to 1.2 in a place like Canada.
You put Canada up there because you say that's a norm.
That's like a reasonably normal. That's a place where we actually do a lot of multinational activity, but where we produce stuff. We don't just do this profit shifting stuff. Canada's like sort of a normal country. Okay, and then Hong Kong and Singapore are like the Ireland and Netherlands of Asia. So when you're doing stuff in Asia, you run it through these companies. Okay,
How
so
does the business accounting work? So there is a change, right? So there has been a change, right? So the payments that you may pay actually for royalties are considered right now as expense, but it could be actually considered investment.
so
right?
royalties.
And then it wouldn't net out from profits, right? I mean, that's something that happened in national accounts in 2013. Well, I don't know what's going on in businesses.
So those are 2 different things. Yeah. So from the national account side, certain things. So to the extent that these patents are things like IT, literally the software and stuff, those are counted as investment, right? If this is trademarks or something, so this is like your Starbucks, and you're paying royalties for the Starbucks name to Seattle, that would be an expense because the BA has decided that coming up with the recipes for frappuccinos is not the same thing as building software. But within the firm accounting, yeah, these are just costs, right? So they're still treated that way.
Yeah, what I'm thinking is whether when you shift all these royalties up there, whether
Yeah.
does it matter, you know, when
It-
you change business accounting. Yeah.
So yes, it could. Yeah, absolutely. Yeah, and that's part of what we're trying to get at here. Okay, so yeah, so exactly where. So okay, so now let's talk about. So that's what's happening. Everybody sort of knows it. We want to go out and try to now undo this sort of shifting and come up with a version of trying to come up with like sort of a real accounting of what multinationals are doing. So the big question is sort of, you know, where does that profit chunk go, right, in terms of national accounting? So here's just like, I don't know, here's just like a quick example, right? So you're Apple, you build an iPhone. It takes about $250 worth of actual physical materials and labor to build the phone. You build it somewhere in China. Right? You sell the phone for $750, and then suppose, just to make life simple, there's no other costs, and these are phones sold outside of the United States. Everything we're talking about here is on foreign profits. It's very hard to move around US profits. There's some ways to do it, but this is mostly for your sales outside of the United States. Right? So, you know, the markup over the actual cost of production is, call it $500. That's the return to all that intangible capital that's wound up in that phone. The brand, the reputation for quality, the iOS, all of these things. So clearly, the $250 of this $750 is not part of US GDP. That's the labor in China, so that goes into Chinese GDP, all the parts built in Taiwan or in Korea. But that $500, where does that go? In the national income accounting, right? Where does that $500 go? And it depends on which part of the company books that profit. So suppose we lived in a world where Apple held all of its own intellectual property in California. Right? So suppose there was no reason to do it. All the patents stay in California. All of those returns, that $500, would all show up back in the United States, and that would be a part of US GDP then. Okay? And what would those be? Those would be an export of services. The iOS is a service. I export that to a consumer in Spain who buys an iPhone, and that's matched by an income flow back into the United States. So if Apple held all of their own intellectual property, that's where that would show up. If instead it books that, it holds that piece of intangible capital in Bermuda or somewhere else, it does its setup, and it books those profits into Bermuda, then they're not a part of U.S. GDP. They're a part of what's called income on U.S. direct investment abroad. Okay? U.S. direct investment abroad is not a part of GDP. It's a part of GNP. Right? So GNP is GDP plus income on foreign investments minus income on foreign investments made in the U.S. plus some other stuff. Right? And so what all this profit shifting is doing is it's taking income that otherwise, if we hadn't done this thing, out of GDP and putting it into income on U.S. direct investment abroad. So what's been going on with this? Looks like this. So this is as a share of private sector value added. So I'm taking the government out, but I'm going to call this GDP, but it's not quite GDP. It's private sector GDP. This is U.S. income on U.S. direct investment abroad as a share of GDP. So it's fairly small in the 1970s and 80s, and then somewhere in the 1990s, this thing explodes. Okay? And we're accumulating a lot of income, or we're earning a lot of income on our direct investments abroad to the tune of now it's at about 4% of GDP per year. Okay?
So someone sells in the US on Apple share, there would be some capital gains there, presumably reflecting all these profits.
So yeah, so
Does that count as US GDP?
the value of Apple stocks? No, capital gains are not a part of GDP. GDP because it doesn't represent production.
Even infer, it's not even
No,
infer
no.
anything.
No, capital gains. If I sell my house and I earn $10,000 on it, that's not part of GDP either. Reselling things it's got to be new production. So
At GNP the whole time, you would not get screwed up because you're just moving from one category to another?
if you look at GNP, so the adjustment we're going to make doesn't change GNP. That's right. It goes from here to here. That's right.
GDP.
It'll move GDP, and what we're going to do today is shrink this and increase this. It's not going to change this. Now,
You would have just been using GNP the whole time. This is second order on that side.
if GNP is a bad measure of what goes on in the United States, right? Conceptually, that's a very different object.
Because, Pat, GNP does have like the earnings of Americans who go abroad and actually do some work
right.
somewhere.
No,
So
but not only that-
you do want to take
But
out.
not only that, it includes GM's manufacturing in Mexico.
Yeah.
It includes Alcoa in Russia.
It
includes a bunch of other
you
stuff.
do want to take out, but it includes some other
But
stuff
that's
that you
what-
want
So,
to
but so you're right, so you're right in the sense that this isn't this. What I'm going to change doesn't change this.
Right.
Whether or not you want to use GNP as a measure of what's going on in the U.S. economy is a different story, right? But yeah, what conceptually what you just said is exactly right.
I mean, for welfare, for like consumption opportunities, GMP is fine. It's the income they receive.
Yeah, exactly. But if you're thinking about measuring productivity,
Yeah.
if you're thinking about measuring labor share of income, if you're thinking about measuring the trade balance, all these things matter. If you think about just the income earned in the U.S., then GNP is going to probably be a good approximation. They're two different measures for measuring two different things, right? So yeah, so exactly. So this is maybe not distorted. This is distorted. That's the difference. Yep.
So one thing, how big is this income compared to actually the total, so the net foreign factor income that comes in? Is this a big chunk of that, or?
I mean, compared to like labor income from abroad?
Yeah.
Yeah, this is big compared to labor income from abroad.
But how much is it from from the capital income abroad that's like really abroad the activity? Go back. See that thing, income on,
Foreign direct investment.
yeah.
Yeah.
Some of it you want to adjust and some you don't. How big is what you want to adjust compared to?
No, this is my
All
job.
of
This is everything.
IAC.
My job is to tell you how much of it I think should be coming back to the U.S. That's my
Yes.
job. That's what we're trying to do today. I know I'm taking a long time to do it, but so I'm just going to go right to the slide. I'm going to skip whatever
That's
those
it.
other two slides
That's
said.
the answer to
this
my
is
question.
this is it. Yeah. So yeah, some stuff is actually really being produced outside of the U.S. and shouldn't be part of U.S. GDP. This is our answer to how much of this should be back in the United States. That's what I want to do today. Right? So let me just tell you how I got to this number, to give you some sense of why I think this is a reasonable number, and then what it means for measurement issues. Okay. But yes, so the difference between these two lines is the sort of real income earned outside of the country that's sort of legitimately there. The blue line is how much of this stuff should be attributed back to the U.S. It's about 2.5% of GDP right now. It's lower than that now. It was 2.5% of GDP. Now it's like what, 2%? 2% of GDP.
So the difference in there, that's like the profits on legitimate activities in Mexico that's taking place in Mexico just using U.S. capital.
Yeah, there is some actual retailing stuff being done, say, in Walmart. That's not just the result of some patent that Walmart owns. They actually do some value added. That's the value added kind of happening outside of the country. This is the return on all this stuff. Yeah, it is tricky. I know. That's why it's a paper.
No. Imagine Walmart invented a system of inventories and how to set things up, and they spent years with lower per period profits only in the U.S. to get their whole system together. Then they basically took a copy of their system and they set up in Mexico City.
Yeah.
And so the know-how of all those 20 years of U.S. stuff, part of it is the actual nice young people working in Mexico, but part of it is the imported know-how. And
Yeah.
They don't literally call it a patent, but it's organizational capital that was developed through working in.
Yeah, no, and that's like,
Is sort of tricky.
yeah, and that's like McGrath and Prescott tried to measure that, right? They say there's some intangible capital, and that's some return on that. So what are we going to do?
You're doing easier to put your
Yeah.
finger on the
Yeah.
intangible capital, correct?
What I'm going to do is basically say what, yeah.
Just do it.
Let me just get to it. Here's what I'm going to do. We'll just do it. Here's what I'm going to do. Let's think about a simple firm. There's a multinational. It has one parent, one affiliate. Okay. They've got some physical capital. They've got some labor. They've got some intangible capital. And the point is, intangible capital. Put it wherever you want. Everybody can use it to produce. So the question is just, what do I do with that intangible capital? So suppose the parent hangs on to its intangible capital, the rights to that intangible capital, where profits are booked. The affiliate profit, it hires some.
Sorry.
Yeah.
Intangible capital, non-exclusive. You can give it to 15 firms. And you
Exactly.
don't-
It's a patent.
Like knowledge.
Exactly. Yep.
Yeah, it's your Walmart inventory,
It's a-
whole wholesale retail system.
Yeah, but it can't be, fine, it can't be stuff embedded in particular managers.
No.
And then they're matched
No.
up with managers,
No.
and then it does,
No.
that's not a.
Yeah, exactly. There's no subscript on that H. That's exactly the assumption. That's our assumption, right? But that's the whole point. Because it's not embedded in anybody, I can stick it in Bermuda. I don't have to have 1,000 engineers in Bermuda. I need to have a stack of paper there, right? Some lawyer stuff. So think about how does the accounting work. So I have a foreign affiliate. They hire some labor. They have some capital because they might do some real stuff. They might actually sell stuff. They use some of this intangible capital. They pay some costs for their labor and capital locally, and then they pay some royalty, some return on the intangible capital, right? So I'm going to call the profits of this foreign affiliate, let's just call that rho. And then the parent's doing the same thing. Apple's hire some people in the US to sell iPhones, to run the retail stores. They use their intangible capital to create iPhone, to have an iPhone. They pay their local costs. They have some, implicit payment to their intangible capital. And then if they're the ones holding the rights to the intangible capital, they're receiving their payment from their foreign affiliates, right? And that shows up as a U.S. This would be an export on the expenditure side. Right? This is what would happen if the parent was holding it. If instead they transfer that patent, the foreign rights to that patent to their affiliate, then what happens? Well, now this foreign affiliate doesn't make this payment to the parent. It accrues as part of profits in a foreign affiliate, and in the parent, it no longer receives, right? It's just a transfer. Instead of this accruing to the parent, it accrues to the affiliate, right? So what we want to do then is I want to separate the real parts, the kind of labor, capital, the productive stuff from just this bit of accounting on whether this shows up here or there. So what I want to do is I'm just going to take some measures now of physical production of things that happen in countries and use it to infer sort of what real profits should have been in each of those locations and then difference out the extra stuff. This is where it looks like in GDP, but we've talked about that a bunch now. So let me kind of show you what we're trying to do. So let me talk about the data. So this is the Bureau of Economic Analysis conducts basically a census every year of US multinational companies. So they go to Google, they go to Xerox, they go to GM, and they say, tell me about what you do in the United States and what you do in all of your foreign affiliates across the world. Okay? So I know...
Wait, Kim, let me just ask you a question.
Yeah.
So now I'm thinking, when I'd heard you talk about this before,
Yeah.
I took the message as being U.S. exports are a lot bigger than you think.
Yep.
And the U.S. trade deficit is
a lot smaller.
than Mr. Trump's. Right? He has
Yeah.
one economist who works for him. What's that guy's name?
Navarro. Peter Navarro.
He's all
Yeah.
confused.
Yeah.
But he's all obsessed about trade deficits, and
Yeah.
it's just not.
Yeah, I'm going to show you that.
Yeah, but you're also solving what they call black matter, right? And
Yeah.
Andre
I'm going to show you that
and
too.
Mauritius, you're
Yeah,
solving
I'm going
that
to show you. I'm
problem
going to show
too.
you that too. Yeah,
Part of it.
I'm gonna
Okay.
part of it.
You can't do the Walmart expertise solution.
No, but the data thing that you're talking about, the fact that U.S. corporations earn higher returns on their foreign
Investment.
than foreign multinationals earn in the U.S. That I'm going to more or less solve today,
All of it?
mostly. It's preliminary. I've solved it for. Yeah, let me show you.
But you're going to put
Let's see it already, go
all
ahead.
those black matter guys, you're going to put them out of business.
I already have put them out of business.
Prescott and McGrattan tried to do something similar.
Yeah, but we're doing something way simpler. Come on, This is tax arbitrage. What I'm doing makes sense. Okay. Anyway, so how am I going to come up with this measurement? So I've got all this data. So I look at. So I look across. So we're going to fix. We're going to do this multinational by multinational. So I fix a firm. I look at all of its foreign affiliates. I look at what it's doing in the United States. Right? And then I just look at some measures of real things happening in a location. So in a geographic location. So here's an example. Here's a parent. I see its reported profits in the United States and in some different countries. Right? So here's a foreign affiliate in country 1, 2, 3. They report very few profits in this country and a lot of profits here. This is like Bermuda. This is like Ireland. And then I look at measures that tell me something about the real things happening in those countries. For example, their wage bill. How many workers do they hire? Right? And how much do they pay them? So here I see very little profit, but a lot of physical activity happening. Here I see very little physical activity, but a lot of profit accruing. Right? And so I want to now, so the model in that sense is profit functions are Leontief and identical across countries. You may not like that assumption, but that's the assumption we're making. And that says this is the adjustment I should make. Profits should be proportional to how much physical activity is happening in a location. That's our model. Right? And so then I'm going to say, okay, in this foreign affiliate, I'm going to assign it actually this much profit. So the difference between the small circle and the big circles has to be reattributed somewhere else. Where does it go? Well, some of it goes here, where we hired a lot of workers and earn very much profit. And then some of it's going to accumulate here in the US, where we don't earn as much profit, but we hire a lot of workers. Right? And so within a firm, we're not creating or destroying profit. We're just rearranging it across geographic locations based on real activity. So I'm showing you something about wages. We can look at actual sales happening. So if we want to think about a retail location, we can think about physical capital. Right? We look at different things that are going to help us understand what's actually happening in a location. So Bermuda is always going to look small. It's always only got a couple guys working there. It has no physical capital. It has no sales, but it has a lot of profits. And then places like Ireland are going to look like they've hired a lot of people, they have a lot of capital, they're doing a lot of sales, but they're not earning a lot of profit, and that's going to want us to reattribute profits from places like here to places like there. And then the part I'm interested in as a US macroeconomist is the part that's going to get reattributed back to the US. Right? And so just a slightly more complicated version of doing this is I'm going to try a bunch of different measures of real activity. So here's sales, here's the wage bill. We've done, the only thing so we do lots of different stuff, it doesn't matter. There's one thing that makes a big difference. If you want to try to look at share of R&D expenditures within the firm, that happens almost exclusively in the United States. So if you think everything is a return on R&D, then our adjustment would be even bigger, right? So, but if you look at kind of real measures like this, we're going to create some weighted kind of apportionment factor based on stuff. I'm going to show you sales and wage bills. And then we're going to say for each member of the firm, we're just going to take that weight, apply it to the global profit from the firm, and say this is what the profit should have been in that geographic location, right? This is what profit should be. It should be small here. And then I'm just going to look at the difference between their reported profit and what I think their real profit should be. And that's this kind of the adjustment that I'm making. Now, the adjustment I'm interested in is this adjustment for the parent. I want to know how much more profit should the parent have made based on the real activity that's happening in all the locations that it operates.
I have a question.
Yeah.
Suppose the Mexican, I'm a shoe company, and I'm based in the U.S., and I set up a branch in Mexico, and the Mexican government grants me some kind of monopoly rights, so that I make twice as much profits per shoe. You would act like it's all the shipping stuff, but I'm just getting actually way higher markup
Yes.
in
Yeah.
Mexico.
Yep. Okay. Yeah. That we can't. Yeah. Yep. That we don't have.
That's getting thrown in. You would
Yep.
attribute it back to the U.S.
Yeah.
as like return on patents and stuff, but it's not.
Yes, that's right.
Okay.
That we can't exactly. Yeah. So this is what we've done. Here's a different way we could try to do, and maybe if I was like Jan de Loker, I could do it. I could try to estimate some structural model where I could try to do that. We're not. So yep, that's right. Profits are gonna. Yep. Yeah. Go ahead.
What about vertical integration? So it's the same idea. If you're manufacturing things in some affiliates, but you're actually selling or doing marketing or advertising and stuff in some other affiliates,
Yeah.
disproportionately going to
Yeah. So.
stay. Like, couldn't stay constant.
Yeah, so we're kind of like halfway between doing the right way and the wrong way, given what you've said, right? So we're going to capture the fact that stuff's happening in that location because they're hiring workers. That's why we're using both. So something like sales is picking up like a pure retail location, right? So you see the Apple store in the UK isn't doing any production, but they're selling stuff. So I want to attribute some profits there. You've got like a factory in China that's producing a lot of stuff but selling nothing. I want to say no, they're actually doing some stuff too. So vertical integration would capture it through the production measures, but we wouldn't quite get it exactly right. Again, we're making this very strong assumption. It's an assumption, but that's what we're doing. So we're getting some of what you're talking about, but not all of it. So what's the benefit? Yeah.
Leontief between what and what?
Leontief profits. Profits on the left-hand side, capital, labor, inputs to production on the right-hand side. Profit is a fixed proportions to inputs.
Yeah.
That's the assumption.
Show us your picture again with the returns to the FDI going up.
This picture, yeah.
Yeah.
What? Yeah.
Yeah, I
Yeah.
don't think that, that the ratio of, I mean, look as a fraction of GDP, the difference between the two of those.
Yeah.
It's not constant. It's not fixed proportions. Whatever's going on in the United States, the piece that they're doing abroad is changing over time.
No, part of it could just be the scale. Suppose I had 0 countries outside of the United States, and now I have 1 country outside the United States. That's going to change that. I just
You're right.
Okay. No, but
But fixed proportions imply all kinds of.
I know,
things
dude,
stay
dude.
constant, and you're in a world where things aren't staying constant.
Dude. I'm being honest, right? That's what I'm doing.
Structural estimation.
Is it perfect? It's not perfect. Is a structural estimation perfect? No. If I showed you a bunch of equations, you go, but how do you know the production function's constant across firms?
So what do you do with your structural estimation?
I don't. I said I could do a structural estimate. Oh, no, could do.
Like some guy who knows econometrics do.
I'm not going to do that. I told you what I just did. That's it. I'm doing something very unsophisticated. Now let me show you what I find.
Okay.
And you can and then we can dig deeper in. If you think what I found is interesting, we can talk about it.
Too hard on yourself, no?
Yeah.
You don't need the NTF production function. All you need is that somehow the endogenous decision for whatever production function they have makes this proportional.
Yeah, no, that- exactly.
In equilibrium.
Exactly. Yeah.
Most utility functions are going to give something like that.
Yeah, you're right. I gave you the strongest assumption to get it, but yeah, there's weaker assumptions. Yeah, what I'm assuming for sure is proportionality. Yeah, yeah, yeah. I'm assuming proportionality. That's what I'm assuming. Whether it's whether you get there from Leontief or something else. Okay, now we only have 5 minutes, so let me just show you some results. Okay, so this is what I showed you before. This is in the aggregate. If I only, you said you just gave me the 5-minute sign. That wasn't.
No, you got 15 minutes.
Oh, I'll still show you the same stuff. I'll just talk slower now. No. If I weight only by sales or I weight only by compensations, or if I only do proportionality compared to sales or to compensation, this doesn't change much. Right? The only thing that would make this line change a lot is if I weighted stuff by R&D expenditures. That happens almost exclusively in the United States, so that would make this line jump almost up to the black line. I'm just, again, that's just sort of, so this is.
Wait, explain that again.
Yeah. So this, right? This red line.
15 minutes. So you
The red line is the outcome. The red line is the outcome if I only look at compensation in a geographic unit to do my redistribution of income. The black line is if I only do sales. The blue line is if I weight things 50-50. If I only looked at R&D expenditures within the company, so I look at Google. Google R&D expenditures are almost all in the United States. So I would say almost all the income earned in Google should go back to the United States. There's not much distribution of R&D across the world. So if you thought that all of this black line was only the return to R&D and there's nobody actually doing anything, selling ads or anything, then I would say almost all of this should go back to the US.
But that's a horrible, but we all know that they do all the research and development in the United States, but they do things.
But they
in the
do,
other
yeah,
countries.
so that's why this isn't the entire black line.
Yeah.
But I'm just giving you some sensitivity
I'm
analysis.
confused.
Yeah, go ahead.
So you said, is this what you did? If you took USD-IA income
That's the black line.
and you subtracted out from it,
What's really happening in the
and
other
you subtracted out, say it's all wages. It's
Yeah,
it's
okay.
only wages.
Yeah, yeah.
And you subtract all the wages, that would already be your,
No. What I say, suppose you're multinational, you have 2 locations, the US and somewhere
you're
else.
talking too fast for me.
Sorry.
Go.
Suppose you're
More
multinational.
clear words.
I'm going to say the same words but
Overall.
slower. Yeah, you said slower.
Okay,
You're multinational. You have 2 locations, the US and Spain.
yeah,
You pay 1/3 of your wages in Spain, total wage bill of your company in Spain, and 2/3 in the United States.
yeah.
You earn all of your profits in Spain. I would say 1/3 of your profits should be earned in Spain, and 2/3 should be earned in the United States.
Now,
And then this line would be 2/3 of this.
The R&D thing.
If I did R&D, you do 100% of your R&D in the United States and 0 in Spain. So I would say all the profits earned worldwide should be in the United States. But that's a close approximation what the data look like. Most R&D expenditure happens in the
except for
US.
fact that- But you didn't subtract out the people in Spain's wages anymore.
No, yeah, exactly.
That's what
That's what I said. Yeah.
Okay.
If I only did R&D, that's what the world would look like. I'm taking some weighted average of lots of things, and I'm trying to, this picture's supposed to make you feel like not worried about which things I'm using. I'm saying the only thing that would make this change is if I looked at R&D by itself. That's the only thing that's like really
If you're presuming,
skewed.
looking at R&D by itself is a confusing sentence.
Yeah.
If you mean.
Oh,
if-
sorry, maybe I should have said any of this.
if
Maybe
you
I should have
said
just been
that-
quiet.
If you said that you assume that the only earnings outside of the U.S. for the
Was
company
R&D,
was a
yeah.
return to R&D, then
Sorry.
by definition it's return to R&D. So therefore, if it's in U.S., it'll all be in U.S.
Now you're talking too fast, but good.
Yeah, but that's what you should have said slower. Or more.
No. Yeah, maybe I shouldn't have said anything. This is just to say that we've tried a bunch of stuff. This is pretty much what it looks like. Now let me show you some stuff. Okay. So first, look at the timing of this. So not much happens. Late 1990s, this thing kind of takes off. What's happening? So why? Why does it look this way for the United States? So there's kind of two big things. So the first thing is the taxes, the actual tax law, and then what's happening in petroleum. So let me show you these two things. So in 1997, the IRS created something called the check the box legislation. The point of it was to try to help small businesses. This is something about how pass-through income works. And it's literally a form. This form 8832 has 6 boxes on it. It meant to help small businesses. Multinationals discovered if you check a specific box on this form, all of this foreign income suddenly becomes not relevant to the IRS. That turned out to be very important. You go talk to tax lawyers, check the box legislation is sort of what's made this work. Obama's given speeches about closing the check the box loophole. Trump probably hasn't, but it's sort of well known that this had a lot to do with the way the firms could now categorize their foreign entities in ways that made them not have to pay U.S. taxes. That happened in 1997, which is about when all of this stuff starts to happen. Now, the IRS isn't stupid. They've been trying to undo some of this stuff. And in 2011, they've tried to do some things to kind of make this less useful. The second bit of tax legislation is something called the cost-sharing agreement. So this goes back to what Tim pointed out the very first time. You take that license, you license that IP from Google to Google Bermuda. That can't be for free, right? Something has to happen there. And the way but you want to pay as little as possible back to the U.S. So they use something called the cost-sharing agreement. It was an important part of doing this, where basically your Bermudan affiliate would kick in some money towards the development of this IP in return to get the rights to use it outside of the United States. In the beginning, these cost-sharing agreements could be almost anything. So you would, not quite, but you would put in 1% of the cost of creating iOS 10, and then you would get the rights to iOS 10 outside of the U.S. Right? So it helped you do this transfer pricing thing between getting the asset out of the United States and into Bermuda. And so these things, this sort of tax law, very much coincides with both the increase here and then the sort of kind of tailing off of this later on. And then I'm going to say this just briefly. Petroleum is actually fairly important. The petroleum industry is a pretty important profit shifter. Exxon last fall just agreed to pay the Australian government $350 million in back tax in back taxes because they were basically caught exactly doing this sort of stuff. Here's the adjustment. So the blue line is what I've been showing you before. If I take out the petroleum industry, you see there's
the intangible capital they're attributed to there.
Exploration. There's different things. So exploration, they can shift profits by doing other things like shipping, which is through intercompany loans. So what Exxon was doing was they'd take out, they would make a loan to their foreign affiliate at a higher interest rate than, say, the market rate, and that would pull profits. There's different ways besides just intellectual property, so petroleum makes a noticeable difference. So, and I'll talk a bit more about industries in a minute, but that's the one industry that I think is worth sort of calling out separately. Okay, here's the industry makeup of these things. So unfortunately, the BEA won't let us show terribly disaggregated stuff, so let me kind of just talk you through some of these things. So this is in 2012. I take the total, so this is what? This is about $250 billion, this adjustment. How does it look over the industries? 40% of that adjustment is in this industry 32, which is a really aggregate industry, but there's 2 industries in here that are important. One is petroleum, which I just showed you, and the other, buried in chemicals, is pharmaceuticals, drug companies, all intellectual property. Where does Pfizer hold their patents? Ireland. What does it cost to make a pill? Almost nothing. Okay? So drug companies are huge profit shifters, and so they're kind of shown up here. Then you got finance and insurance. Where's AIG run all of their foreign operations? Bermuda. Okay? The two biggest companies in Bermuda are Exxon and AIG. Big measured by what? By profits. By employment, almost zero. Right? It's like a couple of guys. Then you get into your kind of tech stuff, your Googles and your Facebooks. Right? And then what's interesting is all these industries that we don't show any kind of profit shifting for. These are all kind of industries where it's hard to separate the location of production and feasible and where you think you've earned profits. Right? It's hard to run a hospital in Mexico and claim that you're earning a lot of profit in Bermuda. What's the intellectual property? What's the patent? I can produce something.
Exxon and some of those, they're not straight patents, right?
Yeah.
I mean, I spent 6 years. I guess it's how the tax lawyers treat it.
Yeah, and I guess the tax lawyers have a harder time separating stuff that looks more like services than from stuff that looks more like manufacturing that's dependent upon intellectual property. Okay, by countries. So we're reallocating stuff right across.
But you know what? Come on, because we economists like to say lawyers, and we think they're bad people or something. You know what? Recently, there's lots of this going on in the United States. The person who runs transfer pricing at Price Waterhouse in the Midwest is a former undergrad student of mine, and she just tried to hire 2 of my PhD guys. They invent all kinds of schemes to do this.
Some they can do it better for some kinds of industries than others. It's easier to do when you have
smarter guys than the IRS hires.
Sure. I don't think it matters what the laws are.
No.
You set up. It's like a constraint maximization problem. You take the laws as the constraints, and then you minimize the amount of tax you want to pay.
Yep. So here's
Using lots of tricks.
Agreed.
But Pat's saying it's shocking that universities and construction companies, they haven't figured out ways to do it.
Yeah, so they haven't. At least, yes, exactly. So here's
they're not hiring good economists.
Possibly.
Okay.
Universities for sure aren't. So here's the cross-country distribution of these adjustments. So this is for 2012. This is just an example. So in 2012, we said the U.S. should have gotten an extra $280 billion in that year. Where's that come from, right? We're not creating or destroying profits. We're just reallocating it. So who's getting stuff taken away from? There's Ireland, 300 billion, 30 billion.
That's like 2%
Luxembourg.
of GDP.
Yeah.
GDP in the United States was 2% higher than we thought it was.
Yeah, so that at the beginning. Exactly. It's like 2.5%. Yep. Bermuda, $30 billion. What's GDP in Bermuda? About 1/6 of that. So when we first did this, I got really nervous, thought we were doing something wrong. So this adjustment can't be bigger than GDP. Then we start talking to guys from the Bermuda Statistics Agency. They're not dumb either, Tim. They hire kind of smart guys. If you're AIG, if you're Chevron, if you're whatever, you're operating in Bermuda, they don't even count you in GDP. They have there's something called an exempted corporation. They say, look, we understand what you guys are doing. We're not going to pretend like you're part of our GDP. So this is 6 times the size of actual GDP in Bermuda. Right? These numbers are huge. This is almost 10% of the Dutch GDP. This is a big number for the Netherlands. These are, this has the Cayman Islands in it. This is also several times the size of GDP.
The Netherlands is counting it in currently?
Yeah, the Netherlands, they are counting them.
Ireland, and people know that in Ireland.
Yeah, they know that.
GDP doesn't really mean much.
They do. Yeah, exactly. So these are coming from places that we understand. I've used no tax data to come up with these numbers, right? Just to be clear, we're just looking at what production stuff is happening. So these line up very well with what we think are tax havens. Here's something I'm going to skip most of this for time, but let me just tell you what other people do.
Yeah, now you have 2 minutes.
Oh, never mind. I'm not even going to show you this. What we do very much lines up with what other people do, and they do regression stuff. Let me show you some measurement implications. Here's value added per worker in the United States. The black line is what you'd measure from BEA's official statistics. This is the two the two horizontal vertical lines are what they call the productivity fast growth regime, and then this is like the productivity slowdown that John Fernald talks about and other people talk about. The blue line is our adjusted line. So when I take all the profit we think should have been accruing back to Google and Facebook and Pfizer as income on investments made in the United States, and add that to GDP, and then look at value added per worker, we see there's a modest divergence between these two lines. Right? Productivity is a bit higher than it should be. Here, if I difference these two lines, you can see it more clearly. So this says this is the cumulative labor productivity growth. So in 1995, basically, they're about the same. In the 2000s, productivity in our measure grows faster than in the official numbers. At its maximum, it's about 2 percentage points cumulative higher than it is in the measured data, and then it kind of falls off a bit as some of this profit shifting is changed. Right? So here's the numbers. So from 94 to 2014, rather than 44.5 log points, 46 log points. And those are the annual. So there's a modest, on the aggregate, there's kind of a modest increase in productivity. It matters a lot more when you start, I already showed you, is not uniformly distributed across the industries, right? If you look at, in particular, R&D intensive industries, so we go and we look at by R&D relative to sales ratios, and we kind of divide up what's R&D intensive and not R&D intensive industries. You see here's the adjustment as a group, as GDP of these industries. Here you see, like in 2008, this is like 8% of value added in these industries. So in industries that seem to have a lot of potential to create intangible capital, the adjustment seems to matter a lot more. On the order of 8%, we're mismeasuring these guys by like 8% of their GDP. And in the non-R&D intensive industries, there's just not much happening. These are sort of the industries that don't seem to be doing a lot of this profit shifting. So we seem to be measuring these guys relative to this mismeasurement reasonably well, and these guys were kind of off by almost 10%. Did you have a question, or? Oh, sorry. Okay. So yeah.
Pharmaceuticals and
Facebook,
entertainment,
yeah,
and all that kind of stuff is about
8% bigger than we thought they were. Yeah.
Right. Okay.
Yeah. Okay. So a couple other kind of measures. All this income.
Let me put one thing.
Sure.
So 280 billion.
Yeah, 280 billion in 2012. Yeah.
So in the national accounts right now, right? So what they call intellectual property products is roughly 1 trillion.
Okay.
So that would give you a boost of, I guess, 1/4.
Yeah.
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 Instead of being 10%, it'd be 12.5%.
Yeah. Yeah.
Can I ask a question?
Yeah.
So when Apple first invents its next iPhone,
Yeah.
and they do that age in US,
Yep.
and then over time they're gonna earn all this money that should be coming back
Yeah.
to returns to that.
Yep.
You're still not, now there's nothing you can do with this to say that original boost, that original delta H, like say this year, should be counted in GDP, even though it hasn't turned into the sale of a dollar. Suppose they invented all this year, but they don't bring it online for 5 years.
Yeah.
Then the true GDP should have the delta H from the increased.
No. You measure GDP when it produces something. Think about a machine. If I build a machine today and I don't use it, that doesn't add anything to GDP. Well, the investment added to GDP, but the output that machine's going to give me, I only start counting once it starts making output. If I plant a tree,
Is that right?
yes, yeah, for sure it is. That's how GDP works. Nope, GDP works. That's how GDP works. All right, so let me. So,
Tim, now you're out of time.
okay, yeah. So I'm going to give you.
Extra 10
Sorry.
minutes.
Okay, fine. Let me just say two quick things. All this income is capital income, is profits. So you think the share of labor is falling in the U.S.? It's actually falling faster than it was. So the black line is official statistics of the labor share. This is Cara-Barbonis and Nyman. The red line is what we say.
Well, Piketty is going crazy about it.
Good. So Piketty would love this paper. It says that workers are even worse than they were. Right? So
But that's wrong. So go on one slide.
this slide?
That delta K, the fact that it makes a difference, that delta K, is because that's precisely the intellectual property product that they add into national accounts. If we were to do the same exercise with physical capital, you wouldn't see a difference between net and gross.
Oh, okay. I'm only, no, all I'm doing is adding some stuff to here. That's all I'm doing. You can take any of these measures. You take your favorite measure, right? All I'm saying is that we're not changing W times L, but we're increasing P times Y. And this would be the incremental, however you want to measure. I'm not taking a stand on any of this, just to say this is all capital income. That's what I'm saying.
The moment you put the slide, right?
Okay, I'm taking a stand that it's all
Even if you
capital
divide
income.
it by a bigger base,
Yeah.
the same wage income.
Yes.
It makes the labor share go down.
Yep. Because I'm classifying this as all capital income.
Yeah.
But that's key too, right?
Yeah, but that's what it's.
Okay, so I'm done. Let me finish.
My coffee.
Okay, let me finish this on this slide, then I'll be done. So yeah, you've been a bad timekeeper. Return on foreign investment abroad. This is GE owning plants in Mexico. 7% per year return. Return on foreign direct investment in the US, Toyota owning plants in the United States, 3%. People look at this number and they go, that seems wacky. Ed and Ellen write papers that say this is all unmeasured intangible capital, and for some reason US firms just have a better intangible capital, and so they earn higher incomes abroad. I say it's all tax. I'm making it look like I'm earning higher profits abroad. When I make my adjustment, this number falls to 2.9%, just about the size, this is about equalized now.
So it's not just Ray and Gorichis you're putting out of business, you're putting Ellen and Ed out.
Well, go over
just
that
saying
again.
some
Let me
stuff.
see if I understand it again. Just repeat that.
Yeah. So forget this column yet. Just look at this column. This just says take the national account statistics. Take income you earn on your investments abroad divided by the stock of assets abroad. The rate of return is about 7%. So that's the rate of return on average that US firms earn on their foreign investments outside of the US.
Yeah.
Do the same thing for foreign companies investing in the United States. Toyota, Nestle, whatever. Their rate of return they earn on their US investments is about half, less than half, 3%. And they say and this is persistent. I'm showing you this for a particular year. This is a persistent difference through time, and people have been puzzled by this. Why is this rate of return difference so big? And they say stuff like net of taxes, but not net of this profit shifting. So yes, net of taxes. So they say stuff like, well, it's riskier to operate outside of the United States. So this is a risk return. Competition is harder in the United States than in the rest of the world, so the return's lower. They tell stories. Yeah. Ellen and Ed have some story that U.S. firms, for some reason, have really valuable intangible capital compared to foreign firms, I guess. And that explains this difference. And all we're saying is the U.S. tax code gives firms an incentive to make it look like they earn really high returns in the rest of the world compared to the United States.
I see.
And we haven't talked about this at all, and I'll finish on this. We don't have the data, but Toyota has an incentive to not earn lots of profits in the U.S. either. They have to do the opposite, right? They want to earn low profits in the U.S. and high profits in Japan.
But what is it? When you make your adjustment, you're turning off their stories. You're assuming
That's right. I'm doing only one thing. It could be even smaller. Yeah.
Or higher. Right? If they had a higher markup abroad.
Yeah. So there could still be some gap here. But we're doing only one story. This is all I'm doing. Yeah, Tim is done. I'll talk to you guys after. Let's have the break. I'll talk to you guys during the break. Yeah, go.